All right, well, welcome everybody to the Tuesday, September 1st session of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by Ken Kavula, my neighbor to the north and renowned investment education raconteur. Welcome, Ken.
I get new titles every week, Mark. That's great.
Yeah, you're going to run out of room on your business card at some point. And we're also joined by Hugh McManus because, again, Hugh is landlocked and we get the privilege of spending more time with Hugh when the planes aren't flying. Good afternoon, Hugh.
Hey, everyone. How are you?
Your ears must have been burning, Hugh, because we're going to be talking about Amazon here in a few minutes and your selections that go back 6 years now.
I want to ask Hugh a question, though. Hugh, how are you handling all this staying at home stuff when you're usually off around the world, not just around the country, but around the world? How are you handling all this, I have to stay at home close to where I live kind of stuff?
Yeah, initially, obviously, itchy feet. It was just tedious and boring, but I'm getting used to it, which is a bit scary. You know?
I'm actually expecting to see a video of you running around in the yard with the Irish Wolfhounds.
Yeah. They're delighted to have me here. They're house training me.
I'll bet they are. All right, well, let's go ahead and get underway. We do have some interesting stuff to kick around. I just love the time cover. Anybody remember the year on that time cover? Magazine covers that feature bulls in torture or tormented bulls are legendary for their contrarian reliability.
99?
99's a good guess. It actually goes back to 1982. We had come out of a extremely long, really nasty period in the market and had a few months of really good market, and time was basically telling us that this is all over. This is just a few years after the death of equities in Business Week, but interesting stuff. We'll probably spend some more time on that bullish magazine cover theme also. We're going to talk about Cramer's COVID-19 index, a little bit about back to school, and we can't leave here without mentioning Apple before the end of the session. We'll just do it quickly, but let's go ahead and get underway. Everybody here knows the drill. We see some brand new people, but a lot of familiar names, leaders in our community that go back decades now. No investment recommendation is intended. This is all about education and demonstrating the principles and methodologies of the Modern Investment Club movement as we analyze companies, build portfolios, and basically just lean on each other to learn and prosper. We may actually own some of the companies we talk about, and we'll try to disclose that, try to remember. We do have a monthly webcast known as the Roundtable that has now been going for 10 years and 1 month. By the way, guys, we tickled up towards 18% for a rate of return earlier this week. So we continue to see pretty good numbers from the companies that we picked, even though we did divest of our Apple a few months ago. If you'd like a reminder about that program, it's always on the last Tuesday of the month, 8:30 p.m. Eastern Time. You can send a note to nkabula1@comcast.net, and Natalie will dutifully add you to the reminder list. She will not inundate you with email. If you have any comments or follow-up following today's session, please send me an email at markr@manifestinvesting.com. I'm getting more caught up on my in-basket. I should be in really good shape here in the next couple of days.
Mark, Natalie asked me to also announce that if you wanted to add your own name right to the guest list at Mid-Michigan, you could go to the Mid-Michigan part of the Better Investing website. That's at betterinvesting.org. And then look for the Mid-Michigan chapter part of that website. And right there, we have a way to enter yourself directly onto the guest list without having to go through a couple of different people typing it and everything. So it's just an alternate way to get onto our guest list.
And it does cut down on data entry error.
Yes, yes.
All right, we started these sessions back in July. We are finding them to be, I think, Ken, I got to say selfishly, they're more good for me, perhaps you, than they are for the audience in some cases. But it's just a continuing demonstration of anytime you dig into a topic and attempt to teach it to somebody, you learn more about it yourself. And that really what it comes down to. We intend to cover a whole plethora of topics here at these weekly sessions, and you can see by the list we add things. Herb Lemkool added one earlier today to think about some of this enabling software that's being used for education, online education these days. But that fifth bullet point down, what is a relative strength index? You're going to see some teasers when we get to some of the Amazon and Hugh McManus content here in a few minutes. And sometime this month, I want to set aside one of these sessions for that fourth bullet point down, hints on recognizing memorable management. Those are a bunch of posts that I had saved from the works of George Nicholson. George Nicholson is largely regarded by many to be the grandfather or the founder of the modern investment club movement back in the late 1930s, early 1940s. His efforts and working with people became the National Association of Investors, which ultimately became tagged as Better Investing. And it's really a series of documents. Ken and I have touched on them in the past. We always love digging into them, and I ran into them just the other day, kind of scrolling around looking for some stuff, and I think it's probably time to dip back into that, especially with some of these companies that are really kind of going nuts here these days.
Mark, I have another one that I'd like to add to that list at some point, and I'd like to take a look at the makeup of the S&P index, the S&P 500 index, and comparing that to the Russell 2000 index. I got some numbers from one of the talking heads yesterday that I was kind of surprised by, where he indicated that financial stocks make up only 10% of the S&P, and I could probably believe that number, but they make up 21% of the Russell 2000. He was coming up with reasons why the Russell was significantly lagging the S&P in the last year to 18 months. And then he followed that stat with another set of stats that said that the S&P was almost 30% technology stocks compared to the Russell, which only had about 11%. I wanted to notice, I wanted to see whether we could verify those numbers first of all, and if so, that gives us a reason maybe for the divergence of the two indexes at the present time, with the hottest sector being kind of overrepresented in the S&P, and the coldest sector, or one of the colder sectors, kind of being overrepresented in the Russell. So I'd like to add that, maybe do a little bit of thinking and examining of those two indexes if we could.
Yeah, and in fact, it might dovetail. Did you see my Cramer quote from earlier today on the forum about, I'm just going to say, settling for the returns of the S&P 500 is something that you should not wish on anyone? I'm paraphrasing, but I think we can have some fun with that also.
Well, it's certainly a quote that you and I believe in. There's no reason to settle for that return with a little bit of careful stock picking, a little bit of careful thought. So,
yeah, that's something that we can dig into, and it's really a strong quote. It came out of some of that stuff you had mentioned with the COVID index. Why don't you go ahead and describe this one for the audience, Ken? Those of you that have not been around here for the last couple of weeks, we have talked about this COVID index from Jim Cramer. It's 100 stocks, and I'll let Ken take it away, but I think it's one of the most interesting examples of theme-driven investment. I don't generally believe in theme-driven investing that much. That may sound strange coming from me. I really do like to shop for opportunities one by one, but Cramer basically put together of stocks that would be affected by and benefit from the index, from people developing vaccines to companies like Zoom that we were talking about a few minutes ago. And Ken, why don't you go ahead and describe what we have seen with this index?
Well, okay, first of all, the graph is showing a full year of data, and the index wasn't put together until the company actually, or the country actually was closed down by the COVID virus. So sometime in mid-March right there is when Cramer comes up with this idea of the COVID-19 index. So prior to mid-March, that's history. And you can always do that for an index that comes onto the market. You can backdate it and see how it would have done, but he didn't have the idea back on January 1st. The idea comes in mid-March, and what he did was he searched for 100 companies without regard to earnings, without regard to size. He looked for 100 companies that he felt would not feel the sting of COVID or would actually prosper in the time of the pandemic. And he put those into an index. Now he's been following it since mid-March, and you can see the results for yourself. They've been dramatic, reaching a high in early August, and then coming back and reaching that high again in late August. And recently, the index has slowed down, as you would expect, as the country begins to open up again and start doing different types of business, bringing more and more business into the back to where it might have been. But for that run from mid-March up until the peak, it was a dramatic increase. And what's more important is not the increase. I don't even know if you could have bought this index anywhere. But for my purposes, it wasn't the index that was so important, but it was looking at the stocks that made up that index. Is that what you were looking for, Mark?
Yeah, and in fact, we created a public dashboard. You don't have to be a Manifest subscriber, but obviously we wish and hope that you are a Manifest subscriber. But there's a public dashboard where all 100 companies are listed, and the results are really phenomenal. And as Ken just said, I think the really cool thing is it basically forced us to add 12 or 15 companies to coverage at Manifest, and that's pretty cool. Here's in fact, this is a reference. This slide actually shows that inflection point that Ken was talking about. He got kind of cold feet back at the beginning of August. He started talking about switching into other types of companies, more defensive companies that were poised to prosper in the recovery. And actually, everything's gone back up, and it's not slumping off at all. But he does talk more and more these days about watching for the Costco's and the Walmarts and the Campbell Soups and the other type of companies, that some of these companies have really prospered from the response to it. Here's a quick look at the top performing companies. And again, as Ken said, Cramer didn't know about COVID back on December 31st, but we're basically doing a year-to-date thing on these companies. And the fascinating thing for me is only 5 stocks out of the 100 have declined. And, $100 invested in them is still worth like 98. So you're not seeing any big drop-offs. 88% of them have beaten the Wilshire 5000. That's a remarkably huge batting average. And the total return is actually 69% based on the way that we're looking at these things. And that's not mid-March to now, that's year to date. 69% for these 100 companies versus 8% for the total stock market. What's interesting is he has been kind of actively managing, adding and removing companies and adding a few companies along the way. And I think we'd argue that he's not adding tremendous value, actually knocked 10% off the total return if you look at the actively managed value for the index. So pretty cool stuff. Again, the important thing is there's some new names on there for us to be studying more carefully. There's an opportunity for field research on Boston Beer. Important. Good stuff from top to bottom. Companies to know about and at least be aware of. There is one merger taking place on the list. Teladoc and I think it's Livongo are becoming the same company here fairly soon, I believe. All right. Quick look at this one. You guys all know this as our recession slide. The real definition of a recession to us is an economic situation that wrecks our stock studies. That's what a recession is. And the other way to think of bit is, when the ocean goes out and the tide goes down, you find out who's swimming naked. Well, in this case, back in 2008, 2009, the weaker performing companies just got massacred. And the question that we've been asking for months is 2020 anything like 2008, 2009? And the answer is that it does resemble it. It certainly has been a lot quicker. I did add the shaded area because the recession officially began in February, for those who keep track of that sort of thing, and is ongoing. But the interesting thing is, the people who follow these companies, the analysts, and again, it's not just Value Line, it's the analyst consensus as covered by Y charts. They are looking for these companies to actually do pretty well in at least the second half of 2021, and continue a fairly healthy trend in 2022 and beyond. So, just something.
Mark, is my memory playing tricks on me, or has the 2021 bar moved up a little bit closer to the trend line than the last time we looked at this?
Yeah, it has. I think it was down in 7.8, 7.7 range for 2021, and 2020 was down closer to 6. So we have seen a little bit of an easing of disastrous expectations, if you want to think of it that way.
Well, that's exactly what we kind of talked about 3 months ago and 4 months ago and 5 months ago, this whole idea of a pendulum swinging, and how we had thought that maybe that pendulum had just swung a little bit too far to the negative side, and we would look for maybe some good news if things started to fall into place the way we thought they might. Mm-hmm. So we're seeing a little bit of evidence of that. Not dramatic. I didn't expect it to be dramatic, but I'm glad that 2021 is back up to trend. That gives me some good feelings.
So the big question that we need to ask is for Hugh. Hugh, have you bought any airline tickets yet?
I haven't. I'm, in fact, still moving them. The ones that I had bought, I'm pushing them further into the future.
So the recovery is not coming in the next couple of weeks, is what you're telling us.
Exactly. Yeah.
Yeah. Any major progress on the vaccine development side that you can share, or any observations on that end?
I keep hearing, I mean, people in the industry that I know that are involved in vaccines, who are normally hyper conservative, really seem to be very, very buoyant about the possibility of the vaccine by the end of the year. I still think it'd be stunning if they're able to do that, but we will wait and see.
Yeah, I hear.
Hugh,
go ahead, Ken.
Hugh, what's this news story about the FDA going to perhaps revise phase 3 guidelines or omit some of the steps in phase 3 guidelines to try to get a vaccine to the public sooner? Have you heard of any of that?
Well, they had the authorization to move things forward a little bit more quickly, and if the efficacy signals are very, very strong, they can accelerate things, and maybe under certain conditions. So, for example, in areas in cancer, they can ask the companies, we will approve your drug. However, we ask you to complete an extra phase 3 trial, post-approval. Often companies don't bother doing that, actually, which is interesting in and of itself. But they're not going to lower the safety bar. That's the one thing the FDA will not do.
Yeah,
yeah. Go on, Mark.
I was just going to say that's where my roundtable selection comes into the BioMarin Pharma actually getting 2 years tacked onto their phase 3 that they didn't expect. So the impact of that is happening. It's not just limited to that one company. All right, let's go ahead and press on. For those that believed that V-shaped recoveries are impossible, I would argue that there are very few things impossible on this planet. And you're looking at new home sales actually just soaring and taking off in recent months, according to the Census Bureau. Here's another one that is a pretty good indicator that we won't have Hugh for every afternoon in the future. Gasoline demand is actually restoring to fairly normal levels. And I believe that you called this one also, Hugh.
Yeah, I've been buying BP when they're not polluting the Gulf, which was another good time to buy it. But this one has been even better. A 25-year low when I was buying it.
Yeah, and the performance of the petrochem and the refiners and the retailers is definitely leveraged versus this type of picture for sure. All right. All right, here's the moment that I've been waiting for. So many of you have been criticizing us for selling Apple at the round table, and I woke up a couple mornings ago, maybe it was just yesterday morning, to a 75% drop in the stock price for Apple. So you heard it here first at the round table. We were right about this one. You know, we said Apple can be prone to very large drops in stock price. So we get a huge "I told you so."
Now you better explain that real quickly, Mark. And we have 4 people that are going to race and spread that all around the community. So
that we don't get it. All right. So that's not what happened. That's not how the math works. Yeah, that stock split is a 4-for-1 stock split. It's kind of interesting to see how many gyrations it puts the reporting mechanisms and robots through on the stock market. But the stock price went from 500 to 125. We would have had 4 times as many shares. Not much really changes, unless you're Tesla. And Tesla seems to be immune from gravity for a variety of reasons. But unfortunately, this is not a dramatically good market call on Apple, which is actually a good thing because I still own it. I think some of you own it too.
Certainly.
And Apple continues to be the most widely followed stock by subscribers at Manifest Investing. So don't anybody panic. Don't anybody call your brokers. Everything's fine. All right. And one last teaser before we get into today's lengthier subject. I find this one to be really fascinating. This actually comes from Blaine Rollins and the research team at 361 Capital out in Denver. He puts together a nice weekly report. You can find it on our This Week summary at Manifest Investing down under the reading references that I attach every week. It's entitled Cloud, but you can see a whole bunch of charts, and this is one of them. I just basically bring it out because I've been actively investing since the early 1980s. And during my entire existence as an investor, this thing has been heading south. And we keep waiting for international stocks to at least aggregately behave better and versus domestic stocks. And this is just wild to me that this has continued for so long. I mean, it was the demise of the efficient frontier that used to be in all kinds of marketing materials that said you had to have X% in international stocks. And what this is telling me is we should be receptive to excellent investment opportunities that are outside the borders of the United States. What do you guys think?
Well, I own 2 mutual funds, Mark, that I've owned for about 30, 32, 33 years now, that invest entirely in non-U.S. Stocks. One of them is pure European stocks, and one of them is world stocks. And to be honest, they've been relatively poor performers compared to what I'm doing in the rest of my portfolio by looking at companies that are domiciled within the U.S. At the same time, I'm still invested in those 2 mutual funds because in their peer group, they're outperformers and they're doing well. And so it's a half full, half empty kind of glass thing. I have 2 really good mutual funds, but they're not giving me the kind of return that I've been able to achieve myself by putting my own U.S. portfolios together. You know that I've exited all of my U.S. mutual funds. I did that quite a while ago in favor of individual stocks and putting together my own ideas. But I don't know what to say, except this graph is telling me that maybe there's some bargains out there. What do you think? It doesn't, there are times when it goes up. There are times when it goes up significantly. It looked like in the early 90s there was a period where it was moving in the right direction.
Right.
So,
And I
yeah.
don't know, to me, maybe it suggests that a stock study of Southwest Airlines should include Ryanair as a potential alternative. That type of thinking, just to watch for some interesting opportunities. And I know, especially on Hugh's perspective on the world, the drug and pharma and biotech areas have a number of companies from outside the United States that are certainly worthy of consideration.
Do the analysts that we use as source material, Mark, do as good a job with European stocks, you feel?
I think so. I think in general that's true. Anyhow, let's keep pressing on. All right, so today's subject is the assessment of companies, especially earlier stage companies. And what you're looking at here is a form of a visual analysis or a business model summary on a company. And I think everybody here in the room would pretty much chant up, straight, and parallel. The top line is the sales. That's whatever this company is. It's a pretty good looking sales trajectory. The stock price has been pretty good over the last 10 years or so. It's projected to do pretty well. And if this were the earnings line down at the bottom, that also looks pretty good. Any debate or argument on that one, Ken?
No debate.
Looks pretty up, straight, and parallel to me. By now, you guys are all starting to guess that the company is Amazon, and that's not earnings at the bottom. It's cash flow per share. It's cash flow per share. And one of the things that we have talked about for earlier stage companies and for performing the same type of analysis that we do on all companies is that sometimes for deeper cyclicals, in some cases turnarounds, and in some cases early stage companies, cash flow can be more informative. And we want to try to persuade you, using Amazon as an example, that type of thinking can be applied to younger companies. We looked at Tesla a few weeks ago, and the fact that we looked at Tesla has driven the stock price up about 170% since we looked at it. So we definitely are moving markets. And I'm kidding. I'm kidding. No one cares what we think. But we do believe that this notion of projecting a return on value, and specifically enterprise value, and we've been putting this slide in all 8 of our sessions so far here at Bull Sessions, we're going to substitute cash flow for projected pre-tax income or pre-tax profit for the purposes of what we do here today. It's my theory, and I can prove it mathematically, that the cash flow as defined by Value Line is going to resemble. It's going to be a little bit higher than the pre-tax income, but it's going to resemble and actually run and track pretty closely with pre-tax income. So we'll be talking cash flow for Amazon. And we do believe this is something of promise that can help us with our special situations or non-core investing. And we love the fact that PEs are not involved. All right, just as a reminder, we all know these curves. We know that companies grow more rapidly as they emerge and become a continuing concern. And we like to be involved in them during the growth stage. This is the time when we really have a lot of fun. But as Hugh has taught us over the last several years, that every once in a while you can put up a visual analysis or a business model pictorial for a company that doesn't have any earnings yet, and it can still work out pretty well. And what I've done is just superimposed a cash flow line to make the point that cash flow arrives earlier in the life cycle of a company than earnings. Again, profits being earnings per share. So again, we're talking about shifting a little bit to the left in the life cycle of a company to, identify a promising situation. And Hugh has actually put the slides up of companies without any earnings, and this is why he's basically playing around in this area. He doesn't do it a lot, but he does it some. And we just thought we would try to dissect a previous decision and show the type of opportunity that's available. One of the things I will point out, and you see this with all companies, if their profits, if they break through and they start making a profit, and for whatever reason, they run into a situation where the profits actually dive back and go negative, that's a really nasty situation. You can be hurt pretty badly as an investor in that situation. The same is true for cash flow. If cash flow turns positive and it looks like the company is making significant progress and heading north and basically heading up these curves, and for whatever reason, and almost every company has one of these moments, it's just a matter of where does it happen in the life cycle of the company, it can be really detrimental to an investor to see it dip back below. All right, here's another way to more concretely make the point for Amazon. And we're actually going to go back and look at that decision, those two decisions to add Amazon to the roundtable back in 2014. What you see up at the top is the earnings per share history for Amazon. And I want you to notice that it actually went negative in this time frame in the red circle. Also notice that because it went negative, I had to switch the scale here, this scale right here, from logarithmic to a standard scale. Now, don't worry about what that means. What it is the answer to the question, why does a stock selection guide blow up when earnings go negative? And that's what happens. That's what we were talking about with that recession slide a few minutes ago. What I want you to notice, and again, cash flow arrives earlier in the life cycle of a company than earnings, and that is certainly true here for Amazon. Okay, any thoughts or questions on that, Ken or Hugh?
I'm very leery, Mark, to make projections off of negative, whether it be negative earnings or negative cash flow. Are you suggesting that when we have negatives in either one, that we can include them in our data and include them as, you know, helping us form the trend line and the projections and everything as well?
Well, there's no negatives in this cash flow data. There is cash.
Well, yeah, no, in this example, there's not. But are you indicating that we could use negative data on the way to coming up with a trend?
I think you can for some of the more speculative companies. We can explore that in a little bit more detail. When we talk about launchpad investing, and many of the people in the audience are familiar with the remarkable achievements of the Broad Assets Investment Club out of St. Louis. They've made a legend out of our annual stock picking contest, because they go shopping for companies that are right here and basically looking for earnings to be positive for the first time in the next year and the year beyond. And they've hit some spectacular grand slam home runs doing that sort of thing over time. So yeah, it's possible. You can actually do some modeling if you get away from some of the math, the logarithmic math. But the point that I'm making here is simply that cash flow arrives earlier in the company life cycle than earnings in many cases. Okay?
If that's the point of this slide, then I'll buy the point.
Okay.
And I understand how you might want to use cash flow until you get some earnings that are stable and moving in the right direction and everything. But I'm not quite sure of the mathematics involved once we start playing around with negatives and things that are popping between negative and positive and negative again. I watch analysts do calculations that just send shivers up and down my spine when they bring negative numbers into the mix, you know. So
yeah, and
the point of this is that we can use cash flow in an early stage company. Yes, I agree with that.
Yeah, and the other thing, and I think this one is probably an example of that, is there can be all kinds of accounting related, tax related stuff in those numbers in the red box that are not present in the one at the bottom. So again, Value Line centers on cash flow for a reason in their analysis. And again, they do stock studies just like we do. They do the same type of analysis, only they use cash flow instead of earnings all the time. And that's one of the reasons that they do it.
Well, I would like to move a little bit to my right brain and talk about the fact that there are other reasons why you might convince yourself that Amazon was a decent stock to look at in 2012 or 13 or 14, and it might have had to do with Jeff Bezos. It might have had to do with the fact that it was a revolutionary model that you wanted to bet on, you know, and I'm perfectly happy. I don't need a mathematical model if I'm going to move into something that I'm going to identify as speculation. I don't need the mathematics behind my speculation, but I do need a thesis that I think has some weight to it and some gravitas, and the fact that you had a brilliant person, you know, firing on all cylinders, dealing with a transformational idea about retail. I think that was worth the money that I put into Amazon somewhere around 2014, you know, and that's before there's any earnings involved with it or anything. It's just not the kind of investment, however, that I'd rush out and talk to 100 of our beginning members and say,
Well,
here's a way to evaluate this. I'm not sure that it made as much sense to evaluate that stock as it did just to think about it.
yeah. Yeah, and I think you just backed into the disclaimer. I mean, not necessarily for beginners. In fact, I would say not for beginners. You have to understand what you're getting into, whether it's Yahoo 1995 or Amazon 2005, whatever. You should be an experienced investor, and it should be that part of your portfolio, as it is with mine, yours, and Hugh's, of more speculation, and we know what the risks are in those type of situations.
Well, I will tell you one thing I've learned since. When was the St. Louis convention when Hugh picked Amazon, Mark? What year was that?
It was Chicago, and we're going to get to that in a minute.
Was it Chicago? Okay. All right.
All right, just a quick note. Again, I think one of the main drivers that you were getting at there, Ken, is that bottom line. Again, that's the sales trajectory. The trend has been pretty impressive. You can go back as far as you want. They've been growing the company. We had to sit and listen to him talk about how he didn't care about earnings, and that cash flow was all that mattered. This is just simply the definition of cash flow margin. Same as net margin, only again with cash flow. It's the cash flow divided by the revenues. And you can see what kind of track record has been established at Amazon and how a number of people who track the company believe that it is feasible for them to deliver on a 8 to 12% cash flow margin. All right. Similar to
Mark, I think we should also say that straight cash flow line, that beautiful looking cash flow line, is not a typical cash flow line for a typical startup company either.
Oh no, these guys have been pretty much exceptional, and they've taken care of things pretty well. All right, a few weeks ago we put up this type of an analysis for Tesla. I'm not going to dive into it too deeply other than to build a couple of pictures off of it. But the thing that we are exploring is how our look at return forecasts might compare to this projected return on value that you see down here. We'll look at some pictures here in a minute. But you can actually see how the company how it's performed over time, what type of return forecasts it's had over the years, and with some attention paid to, and we're going to come back to this, the fact that it's never looked very good, at least not in the last several years at Value Line, in terms of the low return forecast. We want to talk about that a little bit because we have talked about how challenged Value Line can be for this type of company and most early stage companies. Why are they taking on a lot of debt? Well, when you pay a 1% interest rate, it makes sense to load up on some debt as long as you don't overdo it. But let's go ahead and talk about a few things. And here it is, Ken. It actually was the National Convention in May 2014. And the three of us did an in-person, face-to-face roundtable for the Chicago audience. Do you remember that day?
Oh, absolutely, because it was the first time we tried to run a broadcast from the convention, and we found out that there were a lot more problems involved with running a broadcast from a convention than we anticipated. So,
Well, those were learning opportunities. And do you remember your
yeah.
stock?
I no.
Gentex.
Was it a pork-based stock?
Gentex. Excuse me, what'd you say?
Nothing.
Did I do Gentex, Mark?
You did. And I did
Well,
Panera
that's
Bread.
not been a bad. That's not been a bad buy, Gentex.
Well, both Gentex and Panera have performed pretty well. Now, I believe Gentex probably got 80% of the audience vote that day.
That's because they're my groupies at convention.
Well,
Mark.
yeah, when you're surrounded by groupies, that sort of thing. But Hugh, I thought we might go back and just relive the moment. These are actually slides from that presentation 6 years ago.
Oh, wow. Yeah.
And again, we talked about this last week, but just spend just a moment talking about your 52-week philosophy.
For me,
Yeah, go ahead.
it's driven by pure laziness. I mean, I want to get upside, and the best way to get upside is to have the stock trading at a low price. And as long as the earnings engine is intact for a large company, a large cap, or a big company that's a slow grower, however you wish to define it, I like it to be close to its 52-week low. If it's mid-sized, maybe a 3-year low I love. And if it's a small cap company, it means it's had some kind of disastrous news. If it's a biotech, it could be an event in the clinic, funding opportunity was missed, the CEO is caught cooking the books or something. But I'd like a 5-year low if I can, and then you examine the reasons for that low, because a low price has always associated with bad news. But it means that if the earnings engine is intact, or the potential earnings engine is intact, the company is intact, and the low price is not a bad time to buy. And I think it's given me a bit of an oomph in return.
Yeah,
and back then, I think there weren't a lot of companies trading here.
Yeah. Well, here, somebody had asked what type of companies has Hugh studied over the years, and here you go. Here's the next slide from that presentation and how Amazon was near the bottom of your list, or top of your list, I guess. But yeah, there's a number of long-term blue chip core holdings in there, in addition to some play stocks.
Yeah, ISIS is not the organization in the Middle East that does naughty things. It's now IONUS, so it's the RNA-based company, a pharmaceutical company based in north of San Diego. Well, in San Diego, actually.
Mm-hmm. And there's our Vertex.
Yeah, Vertex doing well. Direct, still, I'm hopeful for it. It's doing a little bit better. That price is horrible. I've been tripsing after that one for years. Of course, Staples got assassinated, unfortunately. I was pretty sure they would allow Staples and its competitor to merge, because their competitor isn't Office Depot or any of those. It's Amazon. So I thought this merger would be allowed to go through, but the Justice Department blocked it.
Yep.
And, as a result, Staples got acquired by an investor group. It was spitting off a wonderfully generous dividend for quite a long time.
And for those of you that may not be familiar with the type of strategy we're talking about here, Hugh likes to shop for companies within 20% of their 52-week low. Again, if it's an established company, you can see Amazon was just a little bit above that back in this time frame. Hugh's presentation back then actually dealt quite a bit with free cash flow and Bezos's dissertations on why cash flow mattered more to him than earnings, which used to just make the analysts' blood boil. But pretty good outlook. And this was your conclusion slide, Hugh.
Yeah. Initially, there were not barriers to entry, but he has invested in an infrastructure which would cost a fortune to replicate. And even people with a potential distribution infrastructure really can't pivot to compete with what he's doing. And it is a cash-generating machine. It had its first quarter of profitability either in the last quarter of 2001 or the first in 2002. It was around that time frame. And it made its profit from shipping, of all things. And then a few years later, it decided to monetize that with Amazon Prime. It hasn't looked back since. My only regret is Amazon was a screaming buy for many years before I actually bought it.
And we're going to look at that in a second. Here are the actual two decisions made by Hugh for the roundtable. This gives you some idea of how we track things. You can see the two purchase dates, the first one being May 16th, 2014, and he came back at Halloween that year and doubled down on the selection. We invest $1,000 every time somebody nominates or selects a stock for the roundtable, and you can see that the $2,000 invested in Amazon is now worth $23,400 when you add those two positions together. You can see that he's basically outperformed the market by 35 to 40%. That's per year. Really nice returns there. Good stuff. Just a little flavor for, and this is your teaser on why relative strength is one of those things we probably want to keep one eye on. We don't want to obsess over it or anything else technical, but there are some nuggets of technical analysis that can be helpful. What you're looking at here is a 6-month chart of Amazon back when he selected it the second time during Halloween 2014. And you can see that the stock price had dropped down again approaching his 52-week low, and then the other selection was made back in here. Notice that the relative strength index was basically down at multi-year lows in both cases. A little bit longer term look at the same picture. You can see that the price was suffering on the right-hand side of this chart. And again, that's what got him interested, a company with a really nice characteristic for a top line and the trend for sales in combination with the 52-week low. Here's a quick look at a cash flow based study on Amazon. It's not back at the time of the selection, but it was a little bit afterwards. And you can just see that we're looking at, again, right around Halloween 3 years later, stock price had gone up over $1,000 a share. And the projected return towards the end of that year was somewhere in the high single digits. Notice that the low total return forecast via value line was fairly negative. But again, fairly up straight and parallel when you're looking at cash flow for Amazon. So here's the bottom line that we end up with back from that table that you can study and dissect. By the way, stamp that preliminary. I haven't audited every field in that spreadsheet, but feel pretty confident that it's there. And this is basically what it comes down to. A cash flow based projected annual return on a stock selection guide. Again, that's the Section 5 result, only using cash flow instead of earnings, gives you that top green line. And notice again, the selections were made back in that 2014 timeframe by Hugh. Notice that the PROVE, again, we think that for most companies, the two will resemble each other. Not necessarily track right on top of each other, but they should resemble, and I would argue that there is some resemblance here. And again, as far as historical highs, back in that time frame, you had basically double digit. That's one of the reasons that we've started to pay attention to double digit projected return on value numbers. About 5 to 10% of the companies in our database have double digit projected return on value right now. So kind of interesting shopping amongst those. I just posted an article about that yesterday. And then in the final analysis, again, I think Value Line struggles mightily, as do many of us in this community, with an emerging special situation that includes at least a dash of speculation. And just notice that Value Line hasn't liked this company in terms of the low total return forecast virtually at any point in the last 4 or 5 years. And when I can track down some of the other copies of Value Line to go back and look at the numbers, I think what you'll see is numbers down here. So basically for a company like Amazon, Value Line has always had a tough time developing a decent outlook for a company like Amazon. We did the same type of study for Microsoft back in the 1990s or 1980s. Same situation. Just something to be aware of. And again, just kind of scratch your head over that projected return on value and where it's leading us. We'll leave you with a picture of Lake Michigan in this case, from the shores of South Haven, Michigan. And pretty good days here in Michigan as summer winds down to a close and autumn approaches. Any plans to escape your sheltering, Ken? And
well, it depends on who you're talking to, Mark.
do I need to talk to your better half?
Are you asking me or are you asking my wife? If you're asking my wife, no, we're staying here. If you're asking me, I'd love to get away up north for 2 or 3 days and find a real quiet place to stay for a couple nights. And I don't care if we have to cook in or eat drive-through food. I just would like to get away up north and look at the leaves and the water and everything else. So we'll have to see how Natalie enters into the whole thing.
We need to rent you guys a bubble of some kind and see if we can't figure that one out. All right.
I would like to put Zoom video under the microscope in the next 2 or 3 bull sessions because while I think the case can be made for exceptionalism with Tesla and with Amazon, I'm not so sure the same case can be made for Zoom video. And the huge changes in price over a single earnings report, they concern me. They speak to me that something is operating in the market that is a little bit worrisome. And I'd like to take a look at Zoom and what it's been doing the last since the first of the year at least.
Yeah, I think that's a valid exploration and see what we can come up with.
Yeah.
One last quick reminder before we shut down the formal broadcast, and we can stick around for a few questions and answers, but just a reminder that come Halloween, we will publish our best small companies list for 2020. Our track record is strong. Many of you have helped us. Marie Frank has given us a number of ideas. Kim just brought us another new source of ideas from a guy who runs a small company hedge fund. And you'll be hearing more about that. But again, and companies like Zoom, maybe not now, but 6 months ago, certainly fit into this picture of promising, exciting small companies that have a future. So we will be doing that, and we appreciate any suggestions for further study that you can bring to us. Any other thoughts or comments, Ken?
No, I'm ready to answer a few of these questions, but I think we're going to shut the broadcast down first, right?
Thanks, everybody. And again, scratch your heads and keep bringing the nudges our way. And it's just a joy to be able to take some of the mysteries out of some of this stuff. So thanks, everybody, so much.